The October 26, 2022, 7:30 a.m. First point is attendance. Looks like we have the full board or committee here. Second, I'll ask if there's any public comment. Hearing none, we'll move to approving meeting minutes of July 27th. Is there any discussion or motion to approve?
Take a motion to approve.
Support.
Motion by Brian, support by Michael. Next, we'll turn it over for the Q3 2022 financial investment review by our consultants at ANCO, Brian Green and Mike Holycross.
Right. So I'm doing that thing that we always tell clients to, the comment is always beware an investment professional bringing you up-to-date results, because it usually means there's some type of spin. There's something that has happened recently that is bad enough or good enough that we need to come in and talk about what's happened through yesterday. So assuming this actually cooperates. All right, so I'll go into Bound Book. So kind of talking about things through 9/30. From a traditional stock bond cash standpoint, there isn't a lot of good news to find. You know, from a traditional diversification standpoint, as we've kind of faced the specter of, are we in a recession or are we not? How aggressive is the Fed going to continue to be from an interest rate hike standpoint? You know, what's the underlying impact here from an equity market standpoint. So it's interesting. You know, if we talk about the quarter, you know, the S&P was down 4.9% for the quarter. It's now down 23, almost 24% on a calendar year-to-date basis through the end of September. But September was actually the worst of it. You know, depending on where you were from an equity market standpoint, you were down anywhere from 9 to 12%. So talking about the quarter being down, you know, 4 and change on the S&P, makes it seem like it wasn't as bad as it was, but July and August were actually kind, and September was what really hurt investors for the quarter. Now it's interesting, the reversal we've seen so far here in October. You know, S&P's up 7.7, now down 18 on a calendar year-to-date basis rather than being down 24, which is kind of like saying, Dad, I got in a car accident, but don't worry, it was only the rear end of the car that was damaged, not both ends, right? I didn't total it, it's just a little bit of damage. So it doesn't make the news that much better, but a little bit more palatable. Looking at pages 2 and 3, you know, overall combined portfolio, you know, overall retiree healthcare trust down 6 and change, 6.14 for the quarter versus policy index was down just over 5%. On a fiscal year-to-date basis, so that would be 6 months of performance, down 16.1 versus policy index down 15.4. In the last year, you know, you see the damage of fourth quarter of last year through 9/30 of this year, down about 19.5%. So as I'd mentioned, there's really been, from a traditional investment standpoint, no place to hide. You know, I would say the biggest surprise to investors, you know, while disappointed when opening account statements to see, you know, negative signs across the board from an equity market standpoint, probably the largest surprise from a historical standpoint is, you know, if you start the conversation of, hey, stock market's in negative territory, it's, well, I have a diversified portfolio. I own bonds and cash, so my bonds would have been okay and my cash would have been okay. But, you know, bond market returns are double digit to the negative in the last 9 months and last year as well, as we've seen a massive increase in interest rates. And if you think about it from a cash standpoint, you know, well, the conversation has certainly been more interesting in terms of you're actually seeing a positive return out of money market funds. Certainly savings accounts and money market funds haven't increased at the same pace that treasury bill rates have. You know, those fund managers are finally starting to make fees again. So those interest rates or those compensation rates or interest rates have been slow to rise. But if you said, well, I held cash in the last year, so I'm okay. if you think about it on a real basis, right, after we account for inflation, your cash portfolio might have earned 1% in the last year, but you're actually down 7 when you factor in an 8% inflationary print. So from a traditional diversification standpoint across stocks, bonds, and cash, there's really been no place to hide for investors. On an individual manager by manager basis, it's a bit of a mixed bag. You know, any outperformance, I feel like I've used this a bit too much so far in October in talking with clients, but outperformance in this type of market is kind of an empty victory lap. You know, no one's doing cartwheels down the hallway there's no pat on the back for saying thank you for losing less money than you could have. It's kind of looking on a manager by manager basis. Ancora has held in well, interestingly driven by a bit from an information technology standpoint, as well as some energy related holdings. Surprise, surprise, paying, you know, $4-ish a gallon has definitely been a boon to energy-related stocks. Chevron was one of their best performers, but some other names like Texas Instruments, CVS, and Marriott. Fidelity S&P 500, you know, no surprise, right in line from a performance standpoint. Edgewood is actually attending the FSC meeting at 8. They're going to join. There'll be a representative here in person, and then one of the portfolio managers is actually going to join via Zoom to kind of do a deeper dive and a conversation there. Edgewood has struggled. You know, 22 stock portfolio. What's interesting is, you know, their largest holding is 7.5% of the portfolio. And you look at the Russell 1000 Growth Index, and Microsoft is 10% of that benchmark, and Apple is 12% of the benchmark. So we talk about that strategy being a concentrated portfolio because they only own 22 names, but they have less concentration in single names than the benchmark that they're measured against. So a large degree of their underperformance honestly comes from more from a risk control standpoint of saying, I don't feel comfortable having 12% of the assets in a single stock, or I don't feel comfortable having 10% of the assets in this portfolio in a single stock. And it's actually from an industry standpoint across the board within large cap growth, it's been an absolutely difficult environment because of the level of concentration inside of the underlying benchmark. Clarkston, recall about a year ago having conversations around, hey, what's going on? You know, managers underperforming. You know, we aren't seeing the gains that we're seeing out of the equity markets, out of things like the Fidelity Extended Market Index Fund. Despite slight underperformance for the quarter, you know, on a fiscal year-to-date basis, on a trailing one-year basis, there's that example of, hey, great job losing less money than the market. They actually outperformed by almost 15%. So you see their portfolio down about 6% in the last year versus benchmark down 21. Names like Post, Molson Coors, LPL Financial, so a variety of different names have actually held in and done very, very well for them. Their cable holdings in Altice has not been a driver of performance yet. That was a conversation at a previous meeting, but they continue to hold that position. Fidelity Extended Market Index Fund, you know, probably outside of Edgewood, the largest drag on returns. You see down about 29.5% in the last year. What's interesting is that's actually been hurt by some of the largest names in the portfolio, things like Uber, Airbnb, Lululemon, Snowflake, and one that was a bit of a surprise to me, given the underlying tenets of the organization, but Blackstone is actually the largest holding in that index fund, right? It's the world's largest alternative investment manager, and you've seen a big shift in that business where it's more about, right, it's not market-based performance, it's fee-based performance, and they just keep driving underlying fees from the underlying alternative investment portfolios, and seeing record fundraises and, you know, record amounts of revenue, but really been punished by the market. Bit of a kind of baby out with the bathwater standpoint. From an international standpoint, a bit disappointed in Oakmark. From a historical standpoint, we would have expected them to outperform in a difficult environment, but got hurt really on two names, Credit Suisse, bit of a shakeup in European market, you know, change in CEO, change in leadership, and Continental, right, the tire manufacturer, just as they've faced a number of supply chain issues, that name is traded off, and they've kind of backed off on some of their forward-looking outlook. JP Morgan Emerging Markets, slight outperformance for the quarter, but lagging in the last year. Interestingly enough, their performance kind of year to date has been helped by exposure to the Chinese consumer, but in the last year and a little bit longer has been hurt by exposure to the Chinese consumer. One of the biggest drivers of performance for them was actually Mercado Libre, which I think of as the Amazon of Latin America, as well as some overweight exposure to financials. But the other part of the driver of their underperformance is an underweight to anything from a Gulf state standpoint. So no energy exposure, right? Anything, UAE, Saudi Arabia, right? Names that might look from an ESG standpoint and say, we're going to exclude those. But just given, as we've mentioned early on, Ancora was driven by names like Chevron, right? Record increase in oil prices. So JP Morgan having no exposure to things from a Gulf state standpoint, as those countries have rallied because of the increase in oil prices, that's been a drag on performance for them. Finally, from a fixed income standpoint, again, no place to hide. Baird held in. Having a lower duration exposure has definitely helped. But that's to say, they're only down 3% for the quarter, and the last year only down about 10.5%. We've seen other fixed income managers with longer maturity, longer duration exposure down in the neighborhoods of 15 to 20%. So certainly that kind of shorter duration exposure has helped. And that's helped offset the decline we've seen in Brandywine. Again, longer duration exposure, but most of their exposure is going to be outside of the U.S. A bit of this is currency impact, just as the U.S. dollar has strengthened significantly. But you see underperformed for the quarter on a fiscal year-to-date basis and essentially in line in the last year. But you see the impact of things from an interest rate movement standpoint down about 22% for the last 12 months. So all in all, not a lot of places to hide. As we look at October, if we close the month now, investors would be happy with performance for the month. It doesn't necessarily make you happy with performance for the fiscal year or for the calendar year. But you've seen things rally back from a domestic equity standpoint, anywhere from 7 to 10%. From an international standpoint, up in the neighborhood of 5 to 6%. And fixed income has basically been flat. It's actually slightly negative for the month as we've seen rates continue to grind higher and higher. So as I'd mentioned on the front end, not a lot of good news. Nice to see some outperformance from a couple strategies that we expected to outperform, namely Clarkston. Expected underperformance from names like Edgewood, just given the degree of concentration in the underlying index that they're compared to, but just in kind of a bit of a holding pattern from an allocation standpoint. Thoughts, questions, concerns?
Yeah, Brent, I have a question. On page 4, just want to make sure I'm understanding this. So the loss in the last year has basically wiped out the gains from 2 years ago and 3 years ago.
Mm-hmm.
That's why. So the 3-year column is saying 3 years ago we started with 13 million. We've since added 6.5. But our net returns over the last 3 years is negative 571.
Correct.
Okay. So it's not that we lost money 3 years ago, it's that we didn't make enough money 3 years ago and 2 years ago to offset the 4.6 million we've lost in the last year.
Yeah. Right. So and you think about it, as that pool has grown, a 19% move this year is a larger dollar impact than a 19% move may have been in 2019.
Yeah.
There's the oddity of returns when we can look at you can look and say, you're telling me we're up 0.9% in the last 3 years, yet from a dollar standpoint we've lost $571,000.
Yeah. No, that makes sense.
Brian, on page 2, where we break out each portfolio, I just want to clarify the inception on the public safety losing 17%. It hasn't really lost 17%. That's more of a issue of the timing of when that portion got broken out from the general portion.
Correct.
Because it was in
It was in general
there. It was
prior
just
to
not
that.
allocated directly separately.
Correct.
what do you see as guidance going forward? That's the major question, right?
So we're really in a kind of policy neutral stance, right? In the absence of some fabulous buying opportunity, you kind of shift back to, you know, I'm not going to be overweight stocks versus bonds or underweight this or have a heavy allocation towards that. In this environment, we're going to favor more active over passive, you know, so that's where we have more exposure to things like Ancora versus the S&P 500. We're going to continue to be underweight large cap growth. You know, while we have a very, very high degree of conviction in Edgewood and their team, large cap growth is going to be large cap growth is a difficult environment in a rising interest rate environment. That being said, they have a tendency to snap back pretty quickly and pretty violently. Violently just in terms of the degree and velocity of the recovery and performance. But it comes back to policy neutral, overweight active over passive, overweight value over growth.
Any other discussion, questions for Brian? Staying on the same schedule of meetings, the next meeting would be January 25th, 2023 at 7:30, followed by the FSC at 8. We can discuss more in the next meeting. I just want to bring up myself and another member of the FSC may not be able to attend. We have another meeting that might start at 8 or might start at 9. So we could either discuss rescheduling now or wait till we know for sure and maybe reschedule in the future, or we don't all have to be here, so I mean, you can go on without us as well.
Okay.
Any new business?
Nope.
Okay. Should we have I guess need a motion to adjourn?
So moved.
Motion, Brian,
Support.
support by Michael. Meeting is adjourned, 7:44 a.m.